Hi, I am OG John AG, and I need you to stop whatever you are doing right now because the most powerful bank in the United States of America, the same bank that controls the majority of silver delivery on COMEX, the same bank that was criminally fined $920 million for manipulating precious metals markets, the same bank whose traders went to federal prison for rigging the silver market, that bank is now saying two completely and totally opposite things about silver at exactly the same time. And I'm going to show you both statements side by side, word for word, number for number, because once you see what I'm about to show you, you will never look at a Wall Street silver forecast the same way again. And more importantly, you are going to understand which one of these two contradictory messages is the one JPMorgan actually believes, and which one is designed to make you do exactly the wrong thing at exactly the wrong moment. This is not a conspiracy theory, this is documented, this is on record, and the data behind it is something that mainstream financial media will not put together for you because they need JPMorgan's advertising dollars and they need JPMorgan's access. I do not need either of those things. So let me show you everything. If you have been watching this channel and you understand that the truth about precious metals requires reading what the banks do rather than what they say, hit subscribe right now. About 3 out of 4 people watching this are not subscribed. That community is what makes this channel different from every other finance channel on the internet. If this is cutting through the noise for you, drop OG John AG in the comments right now. Let me start with statement number 1 from JPMorgan. This statement comes from JPMorgan Global Research, the official research division of the largest bank in the United States. On February 25, 2026, JPMorgan raised its year-end gold price forecast to $6,300 per ounce. Let me repeat that number. $6,300 per ounce for gold by the end of this year. That is 22% above where gold is trading today at approximately $5,190. And JPMorgan did not stop there. In the same research note, JPMorgan's analysts made the case for gold reaching $8,000 per ounce, not as a fantasy scenario, not as a 1 in a million black swan, as a realistic outcome if household investors meaningfully increase their gold allocation. Here's the exact logic JPMorgan used. Right now, gold represents approximately 3% of global investment portfolios. JPMorgan's analysts stated that if that allocation rises from 3% to just 4.6%, the demand surge alone would push gold to $8,000, a 1.6 percentage point shift in portfolio allocation. That is all it takes according to the largest bank in the world to send gold to $8,000. On silver, JPMorgan Research published its official silver forecast, and here is what it says. JPMorgan Global Research sees silver prices averaging $81 per ounce in 2026, more than double the 2025 average. And in an updated forecast from The Street Reporting, JPMorgan adjusted its Q4 2026 silver target to $85 per ounce as the price floor rises, double the 2025 average. That is the official JPMorgan Research position on silver. Bullish. Very bullish. And if gold goes to 6,300 as JPMorgan says and the gold to silver ratio compresses from its current 59 to 1 toward 50 to 1, silver goes to $126 per ounce. Pure arithmetic. JPMorgan's own numbers imply $126 silver by year end. That is statement number 1. Now here is statement number 2 from JPMorgan. And this is where it gets extraordinary. Marko Kolanovic is JPMorgan's former chief global market strategist, the man who ran JPMorgan's global research for years, the man who was considered one of the most respected voices in institutional finance for over a decade. His title literally had JPMorgan's name on it, and here is what Marko Kolanovic is saying about silver right now in 2026. Silver is almost guaranteed to plunge 50%. The metal's rise looks completely unsustainable. Bubbles in commodities do not last. And silver could be trading at roughly half its current price later in 2026, 50% drop. That means from current levels around $87, Kolanovic is calling for silver to fall to $43 to $44 per ounce. From $91 where silver hit its 3-week high 2 days ago, Kolanovic is calling for silver to crash back to approximately $45. And Seeking Alpha's analysis of his call is even more specific, stating that Kolanovic warns silver prices may have by late 2026, citing meme traders and rising tensions as the reason the rally cannot hold. This is the same bank. JPMorgan Research Division says silver averages $81 and targets $85 by Q4. Marko Kolanovic, the former chief strategist of that same bank, says silver crashes 50% to $40 or $45. These two statements cannot both be true. They are mathematically incompatible. They describe completely different futures, and the fact that they are both being attributed to JPMorgan at the same time, in the same market, about the same metal, is not an accident. It is a system. And once you understand the system, you understand exactly what is happening right now in silver. But before I explain the system, let me give you the third layer of this story that connects everything, because JPMorgan is not just making forecasts about silver. JPMorgan is actively trading silver right now in the most significant way possible. In January 2026, JPMorgan issued 99% of all COMEX silver delivery notices. 99%. In a market where dozens of institutions participate in delivery, one bank controlled 99% of the physical delivery mechanism. 1,624 delivery contracts processed through a single institution. That is 8.1 million ounces of physical silver that JPMorgan was positioned on for January delivery. And here is the piece that connects the dots between the public statements and the actual trading behavior. The COMEX report dated January 30th, 2026 shows that JPMorgan closed 633 silver short contracts at the exact bottom of the silver crash, not near the bottom, not approximately at the bottom, at the bottom. Silver crashed from $121 down to $63.90, the worst single-day decline in silver history, the worst single-day decline ever recorded for any precious metal, and at the absolute lowest point of that crash, JPMorgan closed its shorts and then in the days that followed, accumulated approximately 3 million ounces of physical silver from COMEX vaults. 3 million ounces of physical silver pulled directly from the exchange right after the crash. So let me paint the complete picture for you, because this is the part that will make you put down your phone and think very carefully about everything you have been reading and hearing about silver. JPMorgan's official research department publishes a bullish silver forecast, $81 average, $85 by Q4, gold going to $6,300. The same bank's strategist publicly warns silver is almost guaranteed to crash 50%. Silver crashes 31% in a single day in January, the worst daily decline in history. At the exact bottom of that crash, JPMorgan closes 633 short contracts. JPMorgan then accumulates 3 million ounces of physical silver directly from COMEX. JPMorgan controls 99% of all January delivery notices. And then just last Tuesday, February 25, 2026, JPMorgan again raises its long-term gold forecast, this time raising the long-term price target to $4,500 per ounce while maintaining its aggressive $6,300 year-end 2026 target. Read that sequence again very slowly. Because what that sequence describes is not research, it is not analysis, it is not a disagreement between two honest analysts who see the market differently. What that sequence describes is a playbook that has been running in the silver market for decades. And here is how the playbook works. You need to understand this because it is the most important thing I will ever tell you about how the silver market actually functions. Step 1. Your research team publishes a bullish long-term silver forecast. This attracts retail investors, momentum traders, and speculative funds into long positions. Open interest builds. Leverage increases. The market becomes crowded with long positions. Step 2. While the market is crowded with longs you helped create, your trading desk builds short positions through futures contracts on COMEX. The research team's bullish forecasts and the trading desk's short positions exist simultaneously in different divisions of the same bank. Step 3. When the market is maximally crowded with speculative longs, you trigger the exit. A margin hike here. A hawkish Fed nomination there. A well-timed bearish statement from a former strategist who still carries the JPMorgan brand name even though he no longer works there. The weak hands panic. Margin calls cascade. The algorithms detect the selling and pile on. Silver crashes. Step 4. Your short positions profit from the crash. You cover those shorts at the bottom and simultaneously begin accumulating physical silver at distressed prices from every forced seller in the market. Step 5. Physical silver now sits in your vaults. You resume publishing bullish research. New retail investors come in at higher prices. The cycle repeats. JPMorgan paid $920 million in fines after the U.S. Justice Department and the Commodity Futures Trading Commission documented exactly this kind of behavior over multiple years. JPMorgan traders went to federal prison for running what prosecutors described as a racketeering scheme in the precious metals market. The Department of Justice did not call it aggressive trading. They did not call it market competition. They used the word racketeering. And after paying $920 million, and after their traders went to prison, JPMorgan continued to be the dominant force in COMEX silver delivery. They did not lose their exchange access. They did not lose their market position. They paid the fine and kept going. So when Marko Kolanovic says silver is almost guaranteed to crash 50%, and JPMorgan Research simultaneously says silver averages $81 this year, you have to ask yourself, which statement is for public consumption, and which statement represents JPMorgan's actual position? And the answer is hiding in plain sight. It is hiding in the COMEX delivery data. JPMorgan is not selling silver right now. JPMorgan is taking delivery of physical silver in the biggest and most aggressive way possible. 99% of delivery notices, 3 million ounces pulled from vaults, 633 short contracts closed at the exact low. These are not the actions of a bank that believes silver is going to $45. These are the actions of a bank that is accumulating every ounce of physical silver it can acquire at current prices because it knows, with the kind of certainty that only comes from controlling the market structure, that the price of silver is going significantly higher. Now let me show you why the data supports the bullish case and why the $50 crash call is the trap you need to avoid. The Silver Institute released its 2026 market analysis, and the numbers are impossible to argue with. 2026 will be the 6th consecutive year of silver supply deficit. This is not a short-term imbalance. This is 6 years of structural deficit, 6 years in a row where the world demands more silver than the world can produce. The 2026 shortfall is forecast at 67 million ounces. Total global silver supply is expected to rise by just 1.5% to a decade high of 1.05 billion ounces, but demand is forecast to run well ahead of that supply. Physical investment demand alone is projected to rise 20% to 227 million ounces, a 3-year high. Industrial demand from solar panels, electric vehicles, AI data centers, 5G infrastructure, and defense electronics is consuming more than 50% of total annual silver mine supply. And here is the part that makes the supply deficit permanent rather than temporary. 70 to 80% of new silver supply comes as a byproduct of mining other metals, primarily copper, zinc, and lead. You cannot build more silver mines when you need more silver. You can only get more silver when copper miners and zinc miners decide to expand their operations for their own reasons. Silver supply is captive to markets that have nothing to do with silver demand. That means when silver demand surges, as it has been surging for 6 consecutive years, the supply response is slow, constrained, and insufficient. The price has to do the adjustment work because the supply cannot. This is why JPMorgan's research division says $81 average and $85 by Q4, because the supply deficit math says these are the minimum prices required to begin attracting enough capital into the mining industry to eventually, years from now, start closing the gap. And this is why the Kolanovic $50 crash call is not a forecast. It is a narrative. It is designed to create sellers where there should be holders. It is designed to create fear where the data says there is no rational reason for fear. Let me now give you the current market picture and the key levels to watch. Silver today, February 26, 2026, is trading at approximately $87 per ounce. It pulled back from a 3-week high of $91.31 that it hit on Wednesday, February 25th. That pullback is being described universally by technical analysts as profit-taking after a sharp rally, not a trend reversal. FX Street stated explicitly today that the white metal remains upward biased, despite retreating after reaching a 3-week high of $91.31. The 50-day simple moving average is at $84.95. The 100-day SMA is at $80.22. Silver is above both moving averages. Silver is in an upward trend structure, and the pullback we are seeing today is occurring on declining volume, which is characteristic of consolidation rather than distribution. If you are watching price levels this week, here is what matters. The $85 level is your critical support. That is where the 50-day moving average sits, and that is where institutional buyers should defend the trend. If silver holds 85 on any further pullback and bounces with volume, that confirms the trend and targets the 90 to 91 zone again. Above 91.31, the next significant technical resistance is 95. Above 95, you are looking at $100 as the next major psychological target. Every analyst who covers silver technically has $100 in their sights for 2026. Gold Silver's lead analyst stated explicitly that silver is expected to trade above $100 in 2026 as supply deficits deepen and industrial demand accelerates. BNP Paribas' Philippe Geisels predicted silver could reach $100 per ounce by the end of 2026. And if JPMorgan's own $6,300 gold target is accurate, the arithmetic of the gold to silver ratio puts silver at $106 to $120 depending on which ratio compression scenario you use. On the downside, the bearish case requires either a resolution of the supply deficit, a collapse in industrial demand, or a complete reversal of the central bank gold buying trend that has been running for 15 consecutive months. The People's Bank of China has purchased gold for 15 straight months, adding 40,000 ounces in January 2026 alone. Total Chinese reserves are now 74.19 million ounces. Central bank demand is averaging 585 tons per quarter globally, according to JPMorgan's own forecast. None of these trends reversed. None of them broke. The fundamentals that drove silver from $28 2 years ago to the current $87 level are intact. More intact today than they were a year ago. So why is Marko Kolanovic calling for $50 silver? I want to be fair to Kolanovic because I believe in showing you both sides. His argument is that silver's recent rally has been driven in part by speculative positioning, by meme stock-like behavior from retail investors, by momentum chasers who piled into SLV and silver futures without understanding the underlying fundamentals. His argument is that when the speculative froth clears, when the tourists leave, the price normalizes back toward the industrial demand floor, and the industrial demand floor is closer to $50 than it is to $90. That is not an unreasonable argument if you believe that the COMEX paper market will continue to function normally, and if you believe that the physical supply deficit can be satisfied through conventional means. But here is why that argument ignores the most important variable, the physical market. In January 2026, when silver crashed 31% in a single day, SD Bullion processed 2.5 times their all-time record transaction volume. Physical buyers did not panic, they bought. Sovereign mints were overwhelmed. Perth Mint shut down new sales entirely. Delivery times went from 2 to 3 weeks to 8 to 10 weeks overnight. American Silver Eagles were selling for $95 to $165 per ounce against a paper price in the 60s and 70s. That is a 110% premium at the peak. When paper silver was saying $65, physical buyers were paying $165 for the same metal. That is not a market where $50 silver is the equilibrium. That is a market where paper price has completely disconnected from physical reality, and the only question is when the paper market catches up to the physical market rather than the other way around. And here is what should terrify the Kolanovic camp. JPMorgan knows this. JPMorgan issues 99% of delivery notices. JPMorgan accumulates physical metal from COMEX vaults after every crash. JPMorgan's research department targets $81 average and $85 by Q4. JPMorgan just raised its long-term gold forecast to $4,500 while maintaining its $6,300 year-end target. JPMorgan's actions are completely inconsistent with a belief that silver is going to $50. You do not accumulate 3 million ounces of physical silver from a market you believe is going to lose 40% of its value. You do not issue 99% of delivery notices in a market you expect to collapse. You do not raise your long-term gold forecast to $4,500 per ounce while predicting that silver goes to $50. None of these things make sense if Kolanovic's forecast represents what JPMorgan actually believes. They only make sense if Kolanovic's forecast represents what JPMorgan wants you to believe. The bank that controls the delivery mechanism, that accumulates physical at the lows, that manipulates the market through coordinated paper selling and margin hikes, that bank does not want you to hold silver. They want you to sell it. They want you to read Kolanovic's $50 warning and get scared. They want you to close your position and sell your metal at current prices so that they can buy it from you and hold it as prices go to the levels their research department is quietly but explicitly forecasting. This is the trap. The trap is not in the market. The trap is in the narrative. The trap is in believing that the same institution that has been criminally fined for market manipulation, that controls 99% of delivery, that accumulates physical at every crash bottom, has your best interest in mind when one of their strategists tells you to sell. The data says hold. The supply deficit says hold. The industrial demand trajectory says hold. The 6th consecutive year of structural shortage says hold. JPMorgan's own research department, when they are talking to their institutional clients who pay them millions in fees, says gold goes to 6,300 and silver averages 81. JPMorgan's former strategist, when he is talking to the general public, says silver crashes to 50. Now, use your own brain. Read what the banks do, not what they say. JPMorgan is issuing delivery notices and pulling physical silver from vaults. That is not the behavior of an institution that believes silver is going to $50. That is the behavior of an institution that is quietly, systematically, and with great precision building a position in physical silver at the exact moment they are publicly predicting a crash. I will leave you with this. The CFTC ordered JPMorgan to pay $920 million for manipulating the precious metals market, the largest monetary penalty the CFTC had ever imposed. The Justice Department described it as a racketeering scheme. Traders went to federal prison, and then the next month, silver deliveries at COMEX continued with JPMorgan in the dominant position. The fine was a cost of doing business. The position was worth far more than $920 million. That tells you everything you need to know about how much silver is worth to the people who actually understand the market. Now use that information to make your own decision. Not JPMorgan's public decision, not Kalanovich's $50 crash prediction. The decision informed by what the largest bank in the world is actually doing with their own capital and their own physical metal, right now today as silver trades at $87 per ounce. Physical will win. The only question is when. Invest with logic, not with hype. Use your own brain. Never follow anyone blindly, including me. OG out.